In today's video, I'll be showing you the 9 purchases that seem like smart retirement preparation between age 59 and 62, but they actually break your system timing before retirement even starts. Through working with clients in this exact window, I've discovered that most pre-retirees load up on getting ready spending right when they should be preserving flexibility. So what feels like preparation is often locking up liquidity in the most tax-sensitive years of their entire lives. This is exactly why I'm making this video today, to show you what to avoid before 62 and why these purchases don't just waste cash, but can cost you tens of thousands in lost tax opportunities between now and age 67. So let's get right into it. Why is this 60 to 67 window so dangerous for big purchases? Well, because this time between 60 and 67 is what I call the retirement red zone. This is a time where the plays that you make matter the most. You're between earning years and distribution years. You haven't yet started those required minimum distributions. You might not be on Medicare yet, and many people have not started Social Security. So this is the ultimate window of opportunity or error. Every financial move that you make now affects your tax planning, your future flexibility, and your retirement readiness. Every dollar spent unnecessarily means less space for Roth conversions, higher modified adjusted gross income, and potentially thousands of dollars in lost Affordable Care Act subsidies or Medicare premium increases thanks to IRMA. You see, liquidity in this window, from what I believe and the planning that we do, is golden. It's what lets us control when and how your income is recognized. And yet so many pre-retirees unintentionally drain that flexibility by making purchases that they think are smart, but they actually handcuff their retirement plan. So the window matters more than most people realize. That should be clear. But now let me walk you through the 9 purchases that cause the most damage. Purchases 1 through 3 are insurance and annuities that lock you in way too early. The first one, long-term care insurance. It's a good product, don't get me wrong, at the right time and in the right amount. Buying it before 62 often means years of expensive premiums with no real benefit during that time. You're committing cash flow in your most tax-sensitive years. We recently had a client with $4,000 in annual premiums for long-term care, which didn't seem like much until it bumped up their modified adjusted gross income just high enough to lose close to $10,000 in Affordable Care Act subsidies. The intent was good, but the timing was not. So yes, you need long-term care insurance, but the right type, the right amount, it's all situational based upon your individual needs. You have to have a plan to pay for long-term care. Insurance should be part of that plan. Make sure you time accordingly. Number 2 is lifetime annuities. The idea of guaranteed income sounds reassuring, and it should be, but income you don't need yet is income that causes tax friction. So it stacks on top of other sources of income. It crowds out Roth conversion space, and it removes your ability to flex your plan. Plus, once you've handed that $200,000 over to the insurer for immediate income annuity, for an example, you've lost control. And control is the single most important advantage in this retirement window. So yes, annuities should be part of your plan, but not the entire plan. Again, in the right amount, in the right timing, annuities are appropriate, just like long-term care is. So make sure that you're using the right amount and the right type, and it's part of your overall plan and process. We use annuities and long-term care in our Red Zone retirement planning process. Just make sure that you're using the right ones. Number 3 is large home renovations. I hear it all the time. We just want to get the house retirement ready. People say that over and over again. But putting $100,000 from your IRA to remodel the kitchen, it's not a spending choice, it's a tax event, and a big one. One client that we had accidentally triggered $20,000 in taxes and again lost an ACA subsidy for the entire year. The kitchen was awesome and great. It was retirement ready, but their financial setback that they had, totally not worth it. So insurance and annuities can wait, and they should be part of your plan. And big home projects need to be funded carefully. Those things should all be clear to you. But the next few are far even more common and dangerous. So purchases number 4 through 6, these are lifestyle spending habits and events that happen that drain your flexibility. So number 4 is luxury cars. A $60,000 car depreciates the moment you drive it off the lot. Meanwhile, that same $60,000 could have gone into a Roth IRA through conversions, growing tax-free for decades. We had a client compare the 2 scenarios side by side. The Roth account would have been worth over $180,000 by age 80. The car was traded in 3 times and it was worth less than $10,000. That's a big difference. Pay attention to that. Number 5, travel club memberships and timeshares. Travel is important, yes, don't get me wrong, and retirement should be enjoyable and fun. But prepaying $30,000 for a luxury vacation package at 61 can cost you far more in tax opportunities than it's worth. You're committing future cash flow now during a time when every dollar should be flexible, not fixed. Remember, cash is key during this time frame. Number 6 is second homes or income properties. Rental income might sound attractive, and it is, don't get me wrong, but the truth is this: it complicates your tax life at the exact wrong time. Not only do you have to manage tenants, maintenance, and upkeep, but the income, again, stacks on top of your modified adjusted gross income, possibly eliminating Affordable Care Act subsidies or raising your Medicare premiums. One client we had lost over $2,000 a year in IRMA penalties due to an extra $10,000 of rental income. The math, it just didn't work. You want your retirement to be simple. If you want to manage a rental property, does that make it more simple? The answer to that question is totally up to you. So now that you see how lifestyle spending can drain your flexibility, again, something that you don't want in retirement. If you want help building your dream retirement as a whole, I want you to go to the description of this video, click the link, and fill out the questionnaire. After you do that, I'll send you a personalized video showing exactly how you can optimize your retirement plan so you can apply this to your own situation. Let's get on to purchase number 7 here, the debt payoff trap. Being debt-free is a dream for many, and for a very good reason. But not all debt payoff is smart. Paying off a mortgage early using your IRA funds is one of the most common and costly mistakes that we see all the time. So just imagine using $150,000 from your IRA to pay off just a 4% mortgage. On the surface, it sounds smart, but that $150,000, it's taxed. It pushes you into higher tax bracket, it ruins Roth conversion planning, and it raises your lifetime tax burden. One client did this, lost over $30,000 in tax savings because of this one little decision. Instead, we encourage clients to build up a plan that eliminates debt strategically over time, usually after optimizing tax smart planning first. So if your mortgage is under 4% and you're sitting in the 12% or 22% bracket, you may be better off keeping that loan and using your cash to fund conversions or to build up your cash reserves. So debt payoff, it's not always the right move. Now, let's talk about 2 more that people almost always get wrong. Number 8 and 9, charitable giving and Social Security planning done too early. So number 8, big charitable donations. Giving is a great thing, but strategic giving is far more powerful. If you're under 70 and a half, you cannot use qualified charitable distributions yet. This means that your donations are either coming from after-tax dollars or triggering taxable events. One client donated $50,000 at age 61 that we had and lost the chance to use a qualified charitable distribution in 10 years to offset their RMD. We always recommend holding large giving for when it creates tax-free impact. That is at age 70 and a half. Number 9 is Social Security planning services. We've seen people spend hundreds on reports and optimization tools before they'd even built out their income map. The reality? Social Security claiming decisions depend on your withdrawal sequence, tax brackets, IRMA, and your RMD timing. And of course, don't forget longevity for the household. Those factors, they aren't finalized until your plan is properly structured. Don't put the cart before the horse. Social Security decisions need to be made in conjunction with your overall retirement plan. So now that you see how timing matters for charitable giving and for Social Security planning, let's bring all of this together so you can see the full picture. So what should you spend money on during this time between age 60 and 67? Planning. This is the highest return on investment spend that you can make. Working with a planner to build a Roth conversion timeline, to optimize your modified adjusted gross income, to time your Social Security strategically, and to build your withdrawal map. Doing all of these things in conjunction together can save you tens of thousands of dollars over your lifetime. We've done this for countless clients through our Red Zone retirement planning process. It's not theoretical, it's measurable over your entire lifetime. And then there's cash, which is a core part of our Red Zone retirement planning process. I love to build up, and we need to build up at least 12 to 18 months worth of cash for a buffer when we enter retirement. This buffer is what saves you during a market dip. It gives you permission not to sell your investments at a loss in a down market. It protects your income planning from derailment due to an emergency or a bear market, because we know life happens. This is how retirees stay retired, with control, not just accumulation. We also strongly advised against taking on any new debt in retirement. That second home, that new car loan, these introduce obligations into a season of life where freedom should reign supreme. We've had clients trapped into making withdrawals just to cover payments that they have, breaking tax strategy and limiting lifestyle. You don't want to make things more stressful in your retirement. Finally here, if you're still working, please maximize your catch-up contributions. These higher limits in your 60s allow you to stack extra savings into the right type of accounts. If you do it strategically, you can use these contributions to create the perfect mix of taxable, tax-deferred, and tax-free assets in retirement, which is huge. So you see, the goal should not be just to have more in retirement. It's about having more control over what you already have. Because remember, retirement is about income, not about assets. That's what we plan for in the Red Zone process. So now that you've seen how these 9 purchases, how they can waste money before age 62, and why that window from 60 to 67 is the most tax-sensitive period of your entire financial life, you can start evaluating every big decision against what it actually costs you in flexibility and tax opportunities. And if you want help building your dream retirement plan, remember, click the link in the description below to fill out the questionnaire. And after you do it, I'll personally send you a video showing you exactly how to sequence your income and avoid the mistakes that cost retirees tens of thousands of dollars through our Red Zone retirement planning process. I'll see you on the next video.